Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxVox. My guest today is Tony Nitti, partner in charge of national tax at the accounting firm RubinBrown. Tony has 20 years of tax and accounting experience and specializes in corporate and partnership tax planning. We'll be talking about the 2017 Tax Cuts and Jobs Act special deduction for pass-through businesses, commonly known by its code section 199 Cap A. Before we begin, our usual bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event is being recorded and will be posted online at TPC's website. We are using captioning, which you can adjust or turn off with the live transcript button at the bottom of the Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Tony Nitti, welcome to The Prescription. It's good to see you.
Howard, thanks so much for having me.
So 199 pass-through deduction was one of the most controversial provisions of the TCJA. Backers said it would create important new tax incentives for many businesses, including small businesses, to expand. Critics said it was little more than a windfall that would generate lots of tax planning, but otherwise little new economic activity. The Joint Committee estimated the provision would increase the federal budget deficit by about $60 billion a year. So let's start with the basics. How does 199 Cap A deduction actually work?
Sure. Well, what's interesting is it's one of those provisions of the code where there's this line of demarcation, and on one side of the line, it's going to be very, very simple. On the other side, it's going to be unbelievably complicated. But the idea, right, was they recognized in the TCJA that the hallmark of that legislation was that they were going to cut the corporate rate from 35% to 21%. And so that changes the math, right? I mean, even with double taxation, the effective rate on C corporation income basically dropped from close to 50% to a little under 40%. But the individual rate only dropped from 39.6 to 37. So had they done nothing for business owners of partnerships or S corporations or sole proprietorships, this historic tax rate advantage they had over C Corp shareholders basically would have shrunk to nothing. So they said, well, we're going to just conjure up this 20% deduction, and it kind of went all over the place. It started at 17 and jumped up to 23, and it landed eventually at 20. But it's not predicated really on any expenditure, so to speak. It's just that you get this deduction of 20% against what is the first of many terms of art here, that's qualified business income. And so, in its simplest form, really, that's all there is to it. Hey, you invest in an S Corp or a partnership or sole proprietorship, you get this deduction of 20% of your qualified income from that business, so that your effective rate, when the Tax Cuts and Jobs Act dropped it to 37, it really drops down to 29.6. So basically, I know it's oversimplifying things. I know there's economic motivation there, sure, but basically you're throwing a bone to owners of pass-through businesses and say, here's the way we're going to continue to give you the advantage that you had before the Tax Cuts and Jobs Act came along relative to C corporation shareholders. But I'll go ahead, Howard.
No, I was going to say, so we'll get into some of these details in a couple of minutes, but I want to talk about the broad economic issues to start with. So in a National Bureau of Economic Research paper published earlier this year, economists from Treasury, the Minneapolis Fed, and Dartmouth found that 199A produced mostly a mouse. They found that while partnerships responded to the 199A incentives by reducing payments to partners, the provision had few other effects. They didn't find wholesale shifts from corporate form to pass-throughs. They didn't find large numbers of workers shifting from employee to contractor status, and they found no economic benefit. To quote from the paper, we find no evidence of changes in real economic activity as measured by physical investment, wages to non-owners, or employment of non-owners. One big caveat was the paper looked at only 2018, so things could change over the long run. But at least in the short term, is this research consistent with what you've seen in the real business world? Has it been kind of a lot of noise about nothing?
Yeah, I mean, ironically, I would suggest that I've seen, more taxpayers in the last few years flip back to being a C corporation than embracing pass-through taxation, just because of that 21% rate coupled with a little lesser known provision. I told you, Howard. I told
There he
you
goes.
you have your voice heard at some point. Hey, old dog, quiet. So we've seen, pass-throughs flip over to being a C corporation because of that 21% rate coupled with Section 1202 benefits potentially 5 years down the road. And so, yeah, I mean, we have not seen nearly as much kind of maneuvering within the pass-through world than maybe people expected originally. As you said, we have not seen people fleeing employee status to become independent contractors. We've seen some tweaks in guaranteed payments becoming pass-through income to maximize 199A benefits. We've seen some gaming, obviously, of S Corp reasonable comp because compensation is not eligible for the 20% deduction, but pass-through income is. So to the extent you can minimize that comp, you can maximize your 20% deduction. But no, I mean, the bigger thing I think, like I said, we've seen is some big law firms and accounting firms that don't benefit from 199A for reasons we haven't talked about yet, but just by virtue of being in this disqualified business, some of them have taken a hard look and actually followed through on flipping over to C corporation status, even though they can't benefit from 1202. The appeal of a 21% corporate rate is pretty significant. And then there's other inherent benefits to C corporation status as well.
So flipping back and forth is obviously not costless, but there's a lot of talk in Washington about raising the corporate rate to 25 at least. Is that going to change the calculation for some of these firms?
Well, I think a lot of that depends on what happens to 199 Cap A. And this is one of my major complaints about 199 Cap A. When you create a provision that's, and again, I know there's a little more to it, but largely tied to what they did to the corporate rate, right? So this 20% deduction really does, if you do the math, it really does put owners of S Corps and partnerships pretty much in the same advantageous position that they were prior to the TCJA. Well, what happens if you only change one piece of that? I mean, what if the corporate rate goes to 25 and the dividend rate goes to 28, but 199 Cap A, which President Biden's proposing it right now, just maintains the status quo? You would all of a sudden have this huge advantage to being a pass-through business, right? Because you'd have an effective rate of maybe 31% as an individual owner of a pass-through business versus what could be over 50% or close to 50% with a 28% dividend rate and 25% corporate rate. And so that's where what's so troubling about all of this is it's hard to envision tweaking the corporate rate and keep tweaking the dividend rate, but not touching 199 Cap A. I mean, you would think these things kind of need to move in lockstep, or else you're going to create a scenario, which is exactly what 199A was designed to prevent, which is kind of business owners feeling like they got the rug pulled out from under them and now they have to switch entity type. And as you said, you can do that easily if you're going from, say, partnership to corporation, but try going from corporation to partnership and sections 331 and 336 are going to have something to say about that, and you're going to be paying a hefty tax bill.
So one of the other issues that came up during the debate was, even with the guardrails, and we'll talk about some of those guardrails in a second, but even with those guardrails, Tax Policy Center has estimated that nearly half the benefit of 199A would go to households making $1 million or more. From your experience, who's benefiting? Are small businesses actually using this at all, or is this really for high-income owners of businesses?
I think what you can say about 199 Cap A is very similar to what you can say about the TCJA as a whole, which is everybody benefits a bit. Certainly, we've seen some small business owners benefit, but there's no hiding the fact that the biggest breaks are at the high end. I mean, when I think about who's benefiting most, right? Just to simplify things, I think about my clients who own, kind of empires of rental property, right? I mean, prior to the TCJA, they were paying a tax rate of 39.6% on that rental income. And maybe even more if they weren't real estate professionals and it was passive. You might have to throw on the net investment income tax as well. So it's been 43.4, right? But then 199 Cap A comes along, and as I said, that rate drops full 10%. It drops down to 29.6 when you're taking a 20% deduction against a 37% top rate. And so, I mean, that's a huge windfall. When you talk about suddenly forking over 10% less of your last bracket of income on your pass-through income, that is really, really significant. And so don't get me wrong, absolutely. I've seen small Schedule Cs and wholly owned S corps benefit, but where we've seen really the more windfall type results are absolutely on that high end, where you're taking that 39.6% bracket down to what is now 29.6.
So the other major criticism, as you've already alluded to, is the complexity of this. So you said, and I think it's really true, 199A seems manageable for those below the income thresholds of under 57,000 for singles and 315 for couples, but it gets really complicated for those at the high incomes. You've written that the Treasury regulations made life somewhat simpler for those claiming the deduction, but how complicated is it still for those, particularly those high income business owners?
As I said before, it is a remarkable difference between under and over the threshold. I mean, under, it's really pretty simple. You still have a couple hurdles, don't get me wrong, right? One of the problems with 199 Cap A is we know you can only take the deduction against what we call a Section 162 trade or business, which is fine in most cases. But with those rental activities, 100 years of case law hasn't definitively answered when does a rental rise to the level of a trade or business. So there's still some issues that lurk when we're under the threshold. But when you're under the threshold, whenever I'm teaching this provision, I always tell people, don't make the law any more difficult than it needs to be. Like when you're under the threshold, you don't have to care if you're in a bad business. You don't have to care about the aggregation rules, the W-2 limits, the UBIA limits that are largely incomprehensible. So when you get above those taxable income thresholds, when the individual owner has taxable income in excess of, I think what's about 329K for 2021 if you're married, half that if you're single, that switch gets flipped and it gets unbelievably complicated. I mean, and it's the rare provision in my mind that offers both computational and definitional challenges, right? I mean, there's some math problems with phasing out the deduction if you're in a bad business and phasing in W-2 and property limits, but it's really the definitional stuff that's driven my industry crazy. I mean, there's no area of the law I've answered more questions about over the last 3 years than simply, here's what this company does. Is it eligible for 199 Cap A? And I understand what they were trying to do, right? They were trying to limit this benefit to capital income and not labor income. And so they want the lawyers and doctors and accountants and actors and athletes to not share in this benefit. But, you handpick architects and engineers and they win while accountants lose. And then you have this nebulous concept of consultants, who's a consultant and who's not. That has really plagued our industry for the last couple of years, just trying to figure out at a threshold level, are we even eligible? And then you have to deal with the reality of that some businesses have a little bit of both, right? Skilled nursing facilities, sure, they provide lodging and laundry and that sort of thing, but they have nurses on staff. Does that put them in the field of health? And some banks have some disqualified activities, and then software companies might do some consulting. And now what do? Do we have two separate businesses? So things get very, very complicated above the threshold because one, we have to be in the right kind of business. Two, even if we're in the right kind of business, we have guardrails, like you said, right? The deduction is limited to potentially 50% of W-2 wages or 25% of W-2 wages plus this 2.5% of UBIA of property. So there's all this computational work that has to get done that, on paper doesn't seem that bad, but in the real world, when all the wages are being paid out of one entity for a related family of companies, you just run into so many headaches and so many problems. And, you really get an appreciation for how much the industry is struggling with the complexity of something when you teach it quite a bit. And you realize that even after sometimes 3 or 4 or 5 repetitions, people are still really struggling. And I'm still waiting for the next grad tax student I have that gets a 199A question right on the exam will be the first one. So that tells you how hard this stuff is.
So one of my favorite issues here is how it treats losses. What do you do there?
Yeah, I mean, you get a very, very strange result potentially, because that loss could absolutely be utilized currently for federal income tax purposes, but will still carry forward, so to speak, in this 199A regime to eventually reduce QBI that you produce in the future, which again, in and of itself doesn't seem that complicated until you think about the way it interacts with other provisions like 461L and 163J. And, you've got all these new loss limitations that are coming into play that create so much problem. And then, of course, CARES Act comes along and allows post-2018 losses to be carried back. And that's left people questioning, well, now what happens to that from a QBI perspective? And so, yeah, it is no picnic. The worksheet that the IRS came up with this year for tracking losses from a QBI perspective, I understand they gave their best effort, but I sat down with that thing in front of me and tried to work through it slowly. And if anybody can figure it out, they're a better person than I am, because it was, it was not intuitive by any stretch, but neither is 199 Cap A when it comes to losses.
So full disclosure, I do some freelance writing. So I'm particularly interested in that catch-all provision that knocks you out if your principal asset is your reputation or your skill. So on one hand, the statute initially sounded like it barred almost everybody, whether you were an obscure freelancer like me or whether you were Tom Brady. Treasury opened the door wider with its regulations, but it still retains some limits. How do you think it did in terms of striking a balance?
Well, I could tell you that, as you said, they borrowed that language obviously from 1202, and they threw a couple extra words in. They added owners and employees, owners to employees. At first, we were all just kind of fascinated with how broad is this, like you said, because, I used to give the example when speaking about a personal trainer, as someone that gets A-list Hollywood celebrities in shape. Well, I mean, you're not in the field of health, so to speak. You're not a doctor or anything like that. But why are these people coming to you if not for your exceptional skill and reputation? And so it was going to be really, really fascinating to see what happened. And then even extrapolating it out to like, a chef, a famous chef at a restaurant. I mean, you would certainly think a restaurant is eligible for 199 Cap A, but if you're this 4-star rated restaurant because of some chef, are people coming there for the food or well, not the food, you get what I'm saying. Are they come in there because it has a reservation open or because of the chef's reputation? And so it would have been really fascinating if they hadn't closed the door. I'm a little surprised at how abruptly they closed the door. They basically left behind 3 types of businesses that are going to be tainted by this catch-all where it says you can't take the deduction if the principal asset of the business is a skill or reputation of one or more of its employees or owners. And basically it's reduced now to endorsement type income, right? Like you get paid to endorse a product, or you get paid for someone to use your name or your likeness or your image or your autograph or what have you. And then appearance fees, like just flat out, showing up somewhere and getting paid for it. Aside from that, they're now telling us nothing's going to fall victim to that catch-all. And it's just what's interesting, Howard, and I know we're not going there today, but I do a ton of work in the 1202 space. And we haven't gotten any of these definitions for 1202 yet, even though that's from 199A took it from. And I'm wondering how much of this can we apply to 1202 as well. But, that's a story for another day.
Yeah, for sure. So we've talked a little bit about this complexity. How much does it actually discourage businesses from taking deduction? Have you come across business owners who basically said, you know what, forget it. Maybe it's worth a few bucks, but it's too much of a headache.
I haven't come across that because, again, I think that as an industry, the tax prep industry, maybe we struggled post TCJA to really capture the value of the extra time that we were spending on things like 199A capitation. So if the clients weren't seeing their bills go up exponentially, then of course they want us to do whatever we could do to get them extra dollars. So it's not that I was seeing that, but what I was seeing and what I was living, and of course you can't blame clients, is just really huge misunderstandings about how this deduction worked. And what I mean by that is you can't imagine how many times I got pulled into a conference call to say, hey, Tony, are we in the right type of business? Can we take this deduction? And I'd have to stop and say, hold on, what is everybody's taxable income generally every single year, right? Because if it's under this threshold, none of this stuff matters. And we'd find out invariably that they were all under the threshold. And I said, then you don't care. You don't care if you're a doctor, lawyer, it doesn't matter. You don't care about wages and aggregation and UBIA, you get the deduction. And so, yeah, I don't think that I've seen anyone that just flat out said, I don't want to go through with this because of the complexity. I've seen some people certainly say, you know what, I don't feel comfortable that we qualify for the benefits based on some of the definitional things as far as the type of business. It's really been the consulting one that causes a lot of problems. And I've seen some of the more risk averse say, no thanks, I'm going to pass on 199 cap.
So the flip side of it is with the generous deduction and all the complexity, I imagine some business owners may be tempted to claim the deduction and wait to see if they get caught, especially with IRS audit rates so low. But you've pointed out that they may face substantial underpayment penalties if they do get caught. So tell us about this trade-off and about this risk.
I will never figure this one out. I really won't, because you gave us a provision that, at least for a period of time, until the final regulations came out, we didn't know what to do with 199 cap A. I mean, it was the Wild West. I mean, the first year we filed, there wasn't even a separate form or worksheet. We were just doing this kind of, on the back of an envelope somewhere and dropping the number onto the return. And what I had to explain to people, again, when I was teaching this subject matter, is the irony is it's so complicated. We understand so little about the way it works. And yet, simply by claiming that deduction on your return, as you alluded to, you greatly drop the threshold for an understatement at which, this understatement penalty will apply. And so what I had to instill in people is the threshold, or sorry, the understatement doesn't have to have anything to do with 199 cap A. You might have nailed your 199 cap A, but simply by virtue of having that on your return, right, any understatement on the return was now subject to this much lower threshold. And so you really had to button up and say, you talked before about just passing on 199 cap A. I always thought of the hypothetical if somebody had just some REIT dividends somewhere that they can claim the deduction against, and they weren't worried about that. They were worried about something else on that return. You had to think long and hard of, hey, if I simply put this 20% deduction against REIT dividends on my return, it substantially reduces the understatement threshold at which I'm going to get hit with this penalty. Maybe I'm better off just not even claiming that deduction. And so I never really understood the motivation behind that. I know they were trying to curb abuse, but it seemed particularly punitive from my perspective.
So let's talk about fixing this. And the timing of our conversation, of course, turned out to be great because Senate Finance Committee Chair Ron Wyden just proposed some major changes in 199A. So he says that his plan would make claiming the credit easier for true small businesses by establishing a single threshold for determining who's eligible and just one definition for qualified business income for all taxpayers. At the same time, it phases out the deduction entirely for business owners making more than that magic number of $400,000 or more. So what do you make of Wyden's proposal? Does it make sense?
I mean, it makes sense in relation to the overall theme of proposals coming from Democrats over the last few years. We all know what that theme is, but the wealthy paying their fair share. As we said before, what probably wouldn't make sense based on their kind of platform, if you will, is leaving 199 cap A the way it is now, in terms of, if you could have millions and millions of dollars of pass-through income. Right now, there's nothing that phases you out by virtue of having a ton of income. If you have enough W-2 wages or UBIA to support it, you get that 20% deduction. And so I certainly think it makes sense to do what Wyden is proposing based on that platform. Again, I don't know that in and of itself wipes out some of the problems that we see. One of the things I do like about it, as you say, is one of the major complaints and criticisms about 199 cap A is the seemingly arbitrary creation of winners and losers between industries, right? I mean, one of the big mysteries is why we have architects and engineers as disqualified businesses in 1202E, but plucked out from 199 cap A. And I've heard different theories on why that is, but the point is, good tax policy, I think, generally doesn't create winners and losers by industry. I understand what they're going for, but there's no reason why a law firm or an accounting firm shouldn't share in a benefit if they're out hiring people and they're investing capital into the business. And I know we think of these as pure service and labor type businesses, but they require capital, they require infrastructure and equipment and computers and everything else. And so I think that what I like about his proposal is, again, raising the threshold a little bit so that if you're a lawyer, an accountant, that's under that threshold, but above the previous thresholds, you'll share in that benefit. But once you get above 400,000 for all filing statuses, you're going to start to lose that deduction, even if you have plenty of W-2 wages and basis, simply by virtue of meeting the Democratic kind of, like I said, hallmark in recent years of making sure that the wealthier taxpayers pay more in tax. And so the one thing I can't imagine you would do is what's currently being proposed by President Biden, which is nothing at all. I don't see how that could end up being the result. But I don't know. There's a number of ways, I think, to tweak or try to remedy 199 Cap A. I think that around the industry, you hear more people than not say, just get rid of it. And listen, I know that the business owners like it. I know lobbyists like it. But, one of the, as we said before, you can move from a pass-through to a C corp pretty easy. So if you feel like you're not getting the benefit you want and you want to flip over to be a C, that can all be done really painless. It's going the other direction that's difficult. And so some have just said, hey, rip 199A out of the code and let the chips fall where they may. Let people decide which type of business they want to be structured as and move in that direction if that's what they want to do. But trying to play this game where you're constantly playing with tax rates to equalize previous benefits, it's going to become problematic, and we might see that come to fruition in the next couple months.
So if Congress wanted to do something to help out small businesses, however we want to define them, so that they're more equal to firms in the corporate form, what would you do? How would you advise them to do this?
It's a really interesting question. What I found so fascinating in the TCJA was the difference between the House and the Senate proposals. And I had done some writing about it when it happened, but there was a period of time where rental owners were really praying that the House proposal came in, because that House proposal gave the biggest benefits to passive income, which seems counterintuitive, but that's how it worked. And at that time, there was no UBIA clause for 199 Cap A. And so, it's interesting. I don't mind this concept of a deduction against it. I do think that as currently constructed, with the thresholds being where they are and certain businesses, like your service businesses being kicked out at fairly low levels of income, I don't think that that's treating all small businesses fairly. I really don't. I think that something more like what Wyden's proposing, where we don't really sweat SSTBs necessarily, we're going to focus more on income levels so that we can preserve this benefit for true small businesses, I think is more in line with what we're after.
So this issue of simplifying the single threshold for determining eligibility and the single definition of QBI, is he on the right track there? Is that actually going to help?
I think you're still going to have issues with aggregation and the like that will have to be dealt with his proposal. Certainly, I couldn't glean from his proposal, did the W-2 limitations UBIA go away, or do those still apply in addition to this phase out over income? I wasn't certain of that when I read his proposal. It wasn't clear to me. But obviously, to the extent you can reduce the reliance on the W-2 limits and UBIA, you'll get some of the simplicity we want. I almost wonder if they should really have it done more at just, forget the aggregation, just do it at the owner level. Like the owner gets passed through their share of, capital tax bases of assets that are in these bits. So that way, whether you're a law firm, accounting firm, hey, if you have hard assets that you purchase, you should share in this benefit. That you could almost do it that way, where at the individual level, you just get allocated all your shares from all these companies of your share of the tax basis, and then you take the deduction against some reasonable rate of return on that amount or something along those lines. But it's difficult now because it's kind of gotten entrenched in the code, and you just wonder to what degree they're willing to rewrite what happened just 3 years ago. But if we could get rid of the reliance on the W-2 wages and just move it to more of an income computation, where it's not picking winners and losers by business, picking winners and losers more by tax bracket, I think that would make a lot of sense to me, and certainly make things a lot easier for my brethren in the tax prep world.
So Tony, we have just a minute left. Let me go back to where we started. If Congress decides to raise the corporate rate to 25%, they just get rid of 199A, kind of no harm, no foul. Will make much difference at that point?
That's just it. I guess part of that depends on, where the dividend rate lands as well. But listen, uh, there are not going to be a lot of tears for my industry if 199 cap A just disappeared. I understand how small business owners feel, but everyone's got the same opportunity to survey the law of the land and where, which entity type yields the best benefit at that point in time, and see if converting that way makes sense. Again, the difficult thing is going from corporation to partnership, but maybe what Congress should be doing again is making it easier to go from entity type to entity type, and then not worrying so much about conjuring up these deductions that level playing field, so to speak, when the playing field's never been level, right? I mean, that's just the hallmark of the way things work. C corps are subject to double taxation, partnerships, S corps are not. And we've had times in the past where the individual rate was so much higher than the corporate rate as it is now, and we've had times where they were almost, equal. And so I don't know. I think it just seems silly to create this incentive and all the complexity that created and opportunities for gaming the system that they then had to shut down in the regulations when I almost, again, I agree with what you say, which is put the corporate rate where you think it belongs, put the individual rate where you think it belongs, and maybe we need some provisions that kind of repeal 331, 336 type provisions where you can move from a C to a partnership if need be.
We are out of time. Tony Nitti, it's real pleasure to talk to you. There's been a fascinating conversation. We'll see what happens after Senator Wyden's proposal gets more consideration in Congress. We'll see where it goes. Thank you again for joining us, and thanks to our audience.
Thanks, Howard. It was a pleasure.